For our next keynote, we have Mr. Jesper Palmqvist, Regional Vice President, Asia Pacific STR, CoStar Group, to give us a comprehensive overview on the last 20 years of the industry. We're glad to have him in person this year. Jesper has led STR in Asia Pacific region since 2013. From the regional headquarters of Singapore, he leads the company and regional team in sales, strategy, and development for the wider region. Please put your hands together for Jesper.
Thank you. Thanks so much. Awesome to be here. I'm also not a king. No kings. It's great to be back. And if you've seen us present, there's a lot of data, a lot of slides. You can scan a QR code at the end and download that, or ask Manav and his great team and you'll have it. So you will have all of it for any questions later on. Where I want to start today in this journey is where we are right now in the global supply pipeline, because we are at that low point. And that might feel weird for some of you when you're seeing release in your market, but globally, before the end of the decade, when it starts again, we're right now at a low point. And that obviously varies around the world. Now in this part of the world, if you compare the dark numbers, which is releasing new hotels over existing in 26, it's quite balanced in this part of the world. Low and slow, pretty good managed numbers. And Vietnam, we were saying for quite a while, how much would that will actually open? How hard will it be? Well, the demand engine of Vietnam is so strong. I was there last week. It's very similar to India. Positive vibes, everyone running, new brands, new hotels. Even if that doesn't all open, close to it will, and it looks pretty good. And then you have the Middle East, of course, where the pipeline long-term probably is okay, but delays for sure, and we'll get back to that in a minute for this year. But I want to talk about 3 points about India and its supply, and I like 3 things. One is, of course, that it's deployed in a reasonably good pace. It's about 20% this year, next year, the year after, not always the case at macro level. The second point is, of course, that we made last year and throughout the year, that you have a tendency, it's all about regional. So right now, if you split it up between what's urban markets and regional, we still have a little bit more. But in the pipeline, it's 2/3 regional. Does that flip it entirely then, 40-60? No, it's a big country, it takes time. But by the end of this decade, we think we'll have, for the first time, more hotels registered in the regional areas than urban. And the last point is, and if you remove economy hotels for that, it's a little bit capricious because they change every hour, every day, every minute, whatever. So if we look at all the other classes, it's reasonably spread, similar across classes. So the pace is good. You're moving all regional, so geographically better spread, and it's spreading by class. It's an interesting maturity in how this is deployed, for now at least. And of course, people who you'll see on stage today, they are releasing more branded rooms. So the top, in terms of the branded pipeline, IHCL, Marriott, Lemon Tree, etc., are putting more of existing brands and new brands across the country in all classes. And they can do that because demand is growing. The last 6 years, the big demand has been in Middle East and Asia Pacific, despite all this great new supply and new hotels that are coming. And it's slowed down, and then it started growing up again, and you can see that 2.2 is bigger than the supply growth globally, and it varies around the world. In India, of course, it's growth over growth over growth over growth. But in China, we had 18 months of negative growth and ADR pressure as well, and it's now finally starting to come back in new first-tier cities. So China's starting to get that engine back in particular markets. Not everywhere, but it's definitely turning. Australia, mature market. Otherwise, in the West, North America and Europe, it's low single-digit growth, a little bit of caution, obviously, before March events. Same thing on rates, plus 1%, plus 3%. It's in Asia Pacific. You see these high rate numbers. The number one driver in the last few years was Japan, but Japan has moved down the order. Yes, half of the flights from China to Japan are now missing, but Japan is still doing okay. Right? It still has a pretty reasonable spread of source markets that changes and reacts, and we know that the rates have reached a high level. Indonesia is a case of occupancy levels down, fiscal spend from government down, and rates are being up. That's not going to last forever. It's been interesting to see once peak season in Bali this summer approaches. But that's on a 12-month. If you look at 3 months, there's still a lot of spikes. Vietnam, peak season, high ADR growth. So when you have portfolios that you own or operate across these markets, you can still see by month and by quarter large spikes in ADR growth and rate growth in these markets, which is not the case globally. But on an occupancy basis, we're kind of back to where we were 7-8 years ago, right? Singapore and Japan, about 80%. Southeast Asian markets rushing 60, 65, up to 70. Most of the growth now is around that mid-reef, 2-3%. That's where most of these countries are growing, unless you're Sri Lanka or Vietnam. Double-digit growth in the last 12 months. Vietnam from that demand that I talked about, in Sri Lanka from yet another recovery story. So that's on the occupancy. And the Indian market still has what we reported last year. It's in the news all the time. Everyone wants a brand. Everyone wants to go regional, finding new types of owners, new money, rolling out better efficiencies and productivity. And all these things are true. IPO, the trail of IPOs and mergers never ends. So it's an exciting time to be here, and that's all still true. And you can do it because of the growth. So we got to look at wider market and the engines and regional. If you look across all these markets, you want to be in that top quadrant there for sure. That's great. You're growing more rate than occupancy is there. And the only ones that are outside it are very narrowly outside it. Very narrowly. So this is an envy of many other countries of any particular size to see that particular growth in the last 12 months on occupancy and ADR. So you have this narrative where we're going broader, regional, more hotels, but it's important that the engines are running. I mean, if we say that, as some people call it big three, even though Hyderabad and other markets are definitely approaching those in numbers, but it's still 1/3 almost of revenue from these three cities. So they need to grow. They have reached particular occupancies and rates. It's all about rates, as you can see. They're growing those rates pretty well, 5 and 12% in the last 12 months. But they also get now with that occupancy compression, as we talk about in Australia, Japan, Singapore, New York, and London. When you have above 90% occupancy, something happens in a market. And it happens like at the airport. When you increase your room nights and your days in a year where you have over 90% occupancy, your rate will go up. It's basic revenue management, less so in Mumbai West. So more markets in India are seeing this, which raises obviously more expectations in how you operationally manage your hotels here as well. So it's clear. Supply is growing in regional and leisure. Demand is growing faster there, but the rates are growing in the big three and in the high-end hotels. So that's the split around all this. So all this, where a market is right now, is very fluid. This image where all these arrows and where a market sits, like Vadodara and Coimbatore, that's going to change. Like in the next 12 to 24 months, you're going to see continuous movements as all of your new brands come in. That's not a static table, so I'm not going to focus too much on that. And instead mention the latest on the extraordinary group events, of course, that you guys have. It's not bulk, it's not discounted like in many other parts of the world. It's about the premium, the F&B, the space, and the rate that you're getting now as a hotel. We're seeing that not just a fad. It's hanging on for maybe longer than most people realized. It's quite extraordinary. And if you look at the macro level, where you blend everything, the fact that you can see such extraordinary spikes in the difference between group rates and single bookings, so transient bookings, is unparalleled in the world. And that premium and how much you get, just on a state like Rajasthan, 5,500 rupees over transient. And it's growing fast in other markets too, 20% growth in group rates compared to others. And the extreme example, of course, in leisure, in weddings, Jodhpur, Udaipur, 10 to 15,000 rupees higher ADR in group than transient. It doesn't exist anywhere else. This is a unique feature that is likely to stay, and it's quite extraordinary. Let's talk about 26 and into the future. So the first 2 months of this year started how? Started pretty good. 49 sub-markets, if we map the entire country, 49 sub-markets, 90% of them were positive in rate. 71 in occupancy. That's a good picture. That's very nice. That's a great start to the year. March softens a little bit. 71% of sub-markets in rates and half in occupancy. Where are they? Well, based on what I said earlier, you shouldn't be surprised that Mumbai, Delhi, and Bangalore are red, because they have high occupancy, the growth is in rates, right? So that 51%, when you go to RevPAR, translates to 57%. So that means 57% of all sub-markets in India are growing in the last 4 weeks in the troubled March. I'm trying to find issues here. I'm trying to be negative because, you know, it's a tough world out there, but it's hard. Because that's a good picture. And that's across many different segments as well. So let's talk more about the bottom line, because I'm excited that way more of our clients today look at profitability in our product now that we have it there. That's exciting, and understand why. Because the cost pressure in the last few years has been tremendous, and it's changed. Your productivity is higher. You definitely look more. My staff ratio in India has gone from this to this, right? And everything's changing from economy to luxury. Better efficiencies through technology, staffing, etc. So it's great. So when the owner, which is clearly a woman, right? She's looking at this guy and she can say, I see the revenue, your rates are higher, where's my profitability? How is it increasing? It should be increasing a lot more. So the owners are looking at that, and we have plenty of examples that this is happening. If you do year over year, the GOP per available room dropping up massively in Goa and Delhi and other places around India. And if you look at, you're trying to find a little bit of that labor cost per available room, is that growing? Well, not to the same extent as total RevPAR and then straight down to EBITDA and your flow through. So it's growing really quickly in the last 12 months, which is not the case globally. So we're saved by that labor cost growth that has been held down. Now, if you look across these markets, you can see this is India as a whole, of course, and if the last 12 months, we had even faster growth, 24 over 23, but there's still growth. And because, again, labor cost is maintained in its growth, you're seeing high profitability, so owners should be a little bit happier. And it's also true when you look at the F&B. We talked about this a few times. There are absolutely developers and owners that say, you know what, I have 8 outlets, I only want to outsource 4. These ones belong to my brand. It's a great conversation to have because profitability in F&B has been under pressure. The cost in F&B staff has been very hard. Now, so when we say that this movement, hotels' revenue in total is now less of F&B and more moving into rooms, part of it is that, yes, but it's also part of that just strong revenue growth. So much is driven by the higher rate growth. We saw the same thing in Japan, seen the same thing in the Middle East and other markets as well. So it's moving. So let's talk about the challenges that we have at the moment, how they're impacting. Now, if they were all the same, you'd be super happy, you just apply the same formula. But that's not the case. You have to adapt all the time to these new changes and how they impact. And it was obviously the case in the Middle East. Everything was busy until it wasn't. So what was the impact there? Let's look at 3 different scenarios around that. And the first thing is to remember, many of you own or operate hotels in the Middle East. So what does it impact the hotels there on location? Domestic, regional, and the inbound. So clearly, the first few days, you see no flights out, hotels are full. All right? Massive uptick, and then airspace opens up. 5 days after that, the international market's empty, and I go down to hotels that have 2% occupancy very quickly. Still a big issue. Then you go to less international markets. You have some displacement to Muscat, right? People went there and then found a way out. They were stuck. Not a bad place to get stuck, I suppose, but 10 days, 8 days, and people were able to leave those markets as well. And then occupancies dropped down. And then we're entering the 3rd week of Ramadan, which is normally a big part of appreciation, celebration, and also normally when hotel demand returns after that slump. Not the case. But there's a parallel. It depends on where you have your hotels. If you have Saudi hotels, a lot of people have entered there with more brands, etc. How do they react? At the end of that, not too bad, because it's largely domestic driven. And yes, after that, if you look into early April, a little bit more drop-off for sure, but it is domestically driven across Saudi markets, not the same in Dubai, right? Dubai just dropped off straight away. So it depends on where you are in the Middle East, for sure. It's very similar to the pandemic, because pandemic and war are the 2 things we really dislike if you're looking at hotel demand. And hotel demand is a pretty good indicator of this, and at this sharp drop, and even sharper now during the war. But why do we think it'll come back? Well, we look at the last crisis, how quickly the Middle East came up, how quickly it came back in all markets. We still think it will, and it will do. It could be healing quickly. Yes, good news last night. Oil price goes down. Stock market says, hey, maybe a ceasefire. We need it to end quickly, and once it ends, we are very confident that this will come back at a good pace as well. The industry is too good to get off like that. Now, second part is, of course, the outbound. All the Middle Eastern people that want to travel to Goa, to India, to Thailand, whatever it is. And you've seen this graph so many times in the news, finding a narrow travel corridor traveling around the world. India has also opened itself up to the rest of the world. You now have about a third of the flights that are international, right? That means great, you're connected, but also a little bit of volatility comes into that. China, 17% international, and it's not moving. It's staying that way. So India continues this opening up to the rest of the world. And Turkey, almost 1 in 5 nights, of course, that means you are very not impressed by what's happening in the Middle East because you're losing out. And the further out you go, less percentage. You might have one hotel that is very dependent on Middle Eastern travelers, but generally less the further out you go. And even if India there is on that map, further down, and there's a lot of people, less impacted than some of the European cities. So we need to split it up into 2 sections. One is the short term. What's the impact in this quarter right now? Phuket is seeing an impact, absolutely. The snowbirds of Europe, they book a cheap air ticket through Qatar, Emirates, whatever. Cancel flight, nervous flight, don't want to get stuck. So that happens, Maldives a little bit. Long term, less so. It looks okay. So again, every day, every week, this continues, puts more damage on the back end, but for now, it's a month or a quarter by quarter analysis that we have to stick to. And Maldives is a good example. Last 2 years, first quarter, great, similar occupancy, moves up and down. Then you move into 26, not so great. Dips down straight away. It's not just the oil price for the seaplanes, it's actual demand via Middle East, from India, from Middle East, from everywhere that is impacting that market. So our forecasting lady over in the US, she does a great job sitting with Tourism Economics, released them on the 27th of February. Not a good date, right? 3 days later, she's like, bugger. I've done all this work, and all is in tatters. No, it isn't. Because some of our markets we now have to revise for new scenarios, floating, like we did during the pandemic. That could be GCC, London, could be Paris, other markets that are dependent, but not everywhere. We still hold that our Mumbai forecast, for instance, is pretty good. Low and slow occupancy and ADR growth on an annual basis. If I look at the quarterly version, sure, that occupancy in Q2 probably should soften, right? But generally, we feel pretty good. So it depends on which forecast you're looking at. So let's round up here and look at what's, apart from forecast, what's the business on the books? This is what I'm saying when occupancy could fall in this quarter. Now, there's 2 sides to that story. If Mumbai is 4.5% down compared to the same time last year, 90 days out, that's not just Middle Eastern war, right? That is also the growth over growth. Last year was growing really quickly. Now you have high occupancy. So don't just believe and say that, oh, that's all down to the war. It's not. It's what happened elsewhere in the market compared to last year. And to the year end, pretty much flat. So pretty good sign. Leisure markets, a little bit mixed. If you're within a 2% margin, I would say, wouldn't worry too much about it because of the booking pace that is changing as well in the booking window. But what is true is that all these lower tier, the regional markets, it's all about where you're putting hotels. That doesn't matter. That will keep growing this year for sure. That looks pretty good. And on weekday impact, there's a huge difference in markets like Kolkata and Udaipur, where Udaipur you'll have this weekend growth, right? The weddings and the luxury, etc., but not so much in Kolkata. So you have these nuances that you got to look at for each market. My final piece is you read in the news and the oil price goes from 115, it goes to 90, go to 80. Petrol prices and what you fill up your car with, if you're not an electric guy, it doesn't really correlate to hotel demand. What matters is if the oil price impacts inflation, interest rates, and the wider scheme. So don't believe all that hype. It's not correlation, causation. And if you're filling up your car at $1 here per liter, you could be in Hong Kong paying $4. It's a little bit worse. So stop complaining. You can scan that and download if you want and pretend to listen to me. But my final thoughts on this is I think everyone agrees that all the macro trends on the baseline of India that you saw last year, they're still there. The GDP growth, the investments that are happening in logistics and around the country and airlift and everything, it's still there. You're expanding very in a balanced way, which almost surprises me, into these regional markets. It's more brands, spread out different brands and more diverse from economy to luxury as well, which is great. And you have a new gold standard that I thought was just a fad in group business ADR. If you are a multi-asset class owner, it's obviously great to see that data centers are still very attractive, the same as logistics and retail and secondary and tertiary markets. So much underused real estate in this country that is ripe for investment. And office sector is still great for many of you who invest in that as well, right? We expect rents to go up in these key markets in the next year for that balanced portfolio that people are after. It's important to remember that your source markets in travel are not rigid. They used to be. 10 years ago, we'd say, like, I have 10% for this, 20% from this country. That will continue to float for the foreseeable future. You're not going to have the same source markets. You've got to be agile and see that. Do I think the answer to this question is yes? I think in India it is, because your productivity is improved. You focus in on efficiency. That's what I hear from owners, from operators, from asset managers, and white labels and everything. I think that's impressive, and it's moving. But remember, there is a hidden number. When your rates are growing and growing, that's not productivity, right? So you got to look behind that in the lines. So same thing applies, as I said last year. Focus on what you can impact. You're not in the White House. You're not a king. But focus on what you can improve in your operational and efficiency. And also, stay positive. It's much more fun. Listen, do I think Sweden's going to win the World Cup now that we finally qualified? Probably not. But it's more fun to think that way. A boy can dream. On that note, thank you so much, and I look forward to speaking to you at the conference. Thank you.
Thank you, Jesper, for always an insightful presentation.